Okay, so let me first thank the organizers. It's a great pleasure to be here. So I'm going to present work which is joint with Daniel Schmidt. So I'm from INSEAD, it's a business school in France, and Daniel is also from France in a different competing, if you want, business school. So the topic of our talk is on the impact of noise trading on stock market liquidity. Noise trading, for those of you who are not familiar, is a very important concept in financial markets. It has very close ties with notions such as market efficiency and others. And essentially what it refers to is the trades that are not related, not motivated by information about stock fundamentals. So these are trades that might be motivated by liquidity needs, by various constraints, perhaps by errors or cognitive biases from which investors might suffer. In the project, I will draw a tight connection between noise trading and retail trading, but I'll show you that they're not the same, and institutions themselves do trades that are akin to noise trades, so unrelated to fundamentals. And I'll be very careful in this project to establish a causal relationship. That is, I will try and really draw inferences that are causal, that is, say how the intensity of noise trading activity affects in a causal way financial markets. And for that, what we need is variations in the intensity of noise trading that is unrelated to the behavior in the stock market. So for these, we're going to be using events of the following type. Let me show. We're going to construct a sample of events that look like the following, which is it's about the O.J. Simpson trial. So when I present that to my colleagues in Europe, I have to explain a lot the context. I don't think you need that here. So on October 3rd, 1995, the jury declared O.J. Simpson not guilty. So now it's been reported at the time that water consumption fell during the time of the verdict announcement, that electricity consumption surged. So people will use the bathroom just before the announcement, not during. They switch on their TVs and so on. So there's evidence that things were happening at the time. What is of interest to us is what happened on the stock market, right, other than on these other markets. And this is this chart shows trading volume on the stock exchange over that day. So from the morning on the left all the way to the end of the trading. And the red line shows the time of the verdict announcement. So the top panel shows basically total trading volume on the NYSE aggregated across all stocks. And what you see is that at around the time of the announcement, trading activity drops, significantly so, and then gradually returns to its original pattern. The bottom two panels break up trading volumes into two groups: trading that can be attributed to retail investors. That's essentially based on the size of the trade. In those days, it was accepted, or it was well known that retail traders traded in small quantities, small trades, whereas institutions were the ones that were trading in larger sizes. Today, this is no longer the case. There's lots of order splitting and so on. But in those days, because of this, the structure of the market and so on, it was a reliable indicator. So you can see that both retail and that's the middle panel, and institutional investors trade less around the time of the trial announcement, and the effect are, in terms of magnitude, stronger for retail investors. Okay, so what we're going to do in that paper is the following. We're going to construct a panel of such sensational news that we will argue is unrelated to the economy. So this is really, that's obvious in the case of O.J. Simpson, but for some other events we're going to be collected, maybe less so. So we're going to create a sample of sensational non-economic news. And in the first part of the analysis, I'll try and convince you that these news affect the way people trade, and in particular affect the way noise traders behave in the market. So I'll show you evidence that both retail and institutional investors are distracted, in line with the chart I just showed you. And I'll try and convince you that those who are the most distractible are those noise traders. Then in the last part of the analysis, having hopefully convinced you that these sensational news events are shocks that are exogenous to the economy, that affect the way noise traders behave, we're going to look at the impact that these shocks have on the stock market at large. And we'll have a particular focus on liquidity, but we'll look also at volatility, at reversal in prices, and so on. And what we'll find, I'll go into more detail later, is that yes, you can pick up, you can detect a drop in trading activity on the sensational news days. You can detect a drop in volatility. Prices reverse less. So there's sort of a positive shock to autocorrelations in returns. And liquidity worsens on these days. And we're going to argue that all these events, all these observations can be tied together and have a common cause, which is precisely that drop in the noise trading intensity that we argue has happened. Okay. So this is work that will contribute to the large and growing literature on limited attention in financial markets. It's now widely recognized that investors suffer from limited attention, but among the various constituencies that have been analyzed, speculators, market makers, noise traders have been so far mostly neglected. So we look at the impact of limited attention on noise traders. We also make, we think, an important methodological contribution in the sense that much of the literature on limited attention has focused on, or has used, in order to establish causality, has used events that attract attention. So news about a stock generates extraordinary trading, and let's look at what happens then. But typically, this type of events are maybe plagued by confounding events. I mean, there's a reason why attention has been drawn to that particular stock and so on. So we take a different focus. We look at distracting events. All right. So and hopefully this is going to help us mitigate concerns about this potential confounding news. We contribute to the literature on determinants of liquidity in financial market, focusing really again on these causal inferences. There aren't that many papers which have so-called exogenous events that allow you to talk about causality. And in particular, we're going to emphasize the adverse selection implication of noise trading. And then we also contribute to the behavioral literature, behavioral finance literature, in particular by looking at the interplay between attention and behavioral stuff. So the first part of the analysis is to identify these sensational news events, such as the O.J. Simpson trial. And the way we do that is we rely on work that has been carried out before by others for completely different purpose. So there's a QJE paper came out about 10 years ago by Janssen and Stromberg, who are interested in essentially understanding the determinants of financial aid from the US to disaster-hit countries. And what their hypothesis was that it had to do with the intensity of media coverage in the US for these disasters. And for that purpose, they had developed a measure which they called news pressure, which captures the intensity of media attention. So we use their measure, and but we adjust it in some way in order to pick up what goes on in terms of noise trading intensity. So this is the time series of their news pressure measure. This is measured as the median time that is devoted to the top 3 news segments across the top 3 news broadcasters, ABC, NBC, CBS. You take the news, I think the 7 o'clock news, 30 minutes news, how much time has been dedicated to the first 3 news segments. The idea being that if more time is dedicated to the first 3 news segments, then it means that's really important news that's happening. So the O.J. Simpson trial, for example, you can see it on that chart, was the highest news pressure for that particular year. It attracted a lot of attention. So a lot of these news is economic news. So we go to great lengths to disentangle economic from non-economic news. Fortunately, we have the headlines, and what we do is that we run a keyword search to eliminate from our sample events anything that has to do with the economy, with all sorts of keywords. Okay. I can talk about that later if you're interested. We conduct this is a standard event study. I'm not going to bore you with details, but we look at abnormal stock market variable on the sensational news day, O.J. Simpson trial, for example, and conduct, use inferences using standard techniques, parametric, non-parametric. Okay, just as a starting point, let me just show you evidence that investors are indeed glued to the TV on these particular days that we outline. And if you use data from TV viewership, you see that it surges on these particular days. Right? So there's really something going on there, as we suggest. So we have all sorts of data sets. Without going into detail, I just want to point out that our overall sample spans 1968 to 2013. It's a long time series. We use all sorts of data sets which have different time spans. So as a result, different data sets correspond to a different number of events. So in total, we have 500 and something events. I forget exactly, but depending on the data that we're using, we may have to restrict our sample. 532 events. That's what we have. Okay. Okay. So having defined these sensational news events, let me try and convince you that noise traders are being distracted from trading. So let's look at the behavior of investors on these particular days. Okay. So for that purpose, we have two detailed data sets that are classic, that have been widely used in academic research. The first is essentially trades from a large discount brokerage going back to the 90s. 6 years of data. What we do is that we look at how households trade on sensational news days compared to other days. And again, remind this is an event study. So the chart on the left shows over a 10-day window centered on the sensational news day, the intensity of trading by households. Okay. Actually, on this particular chart, there's the number of households trading, but I could have done trading volume would have been exactly the same. What happens is on day 0, the event day, trading goes down by roughly 6%. Okay. It's not large, it's modest, but it's statistically strong. It's strong enough that we can detect it. And it happens essentially at the extensive margin. That is, households, 5% roughly of households, do not participate in the stock market on that particular day. There's not much going on at the intensive margin. If you do participate, you trade as much as you ever did. Right? On the right chart, I show you essentially the similar analysis for a sample of institutions. So this is data from Abel Noser, Wancherno, which collects data from institutions. It's a company that provides advice on how to optimize trade execution. The periods are not the same, but they're not overlapping sample periods. This is from the Abel Noser, is, I think, from 1999 to 2010 or so. But again, we see a similar pattern. That is, if you conduct the event study, on the sensational news day, institutions trade less by about 4%. Nothing happens before, nothing happens after. Okay, so traders are distracted on these sensational news days. And interestingly, you don't see anything going on the day following, on day 1, day 2, following these events, suggesting that these trades were either hyper time sensitive. If you could not do them on day 0, then it's not worth doing them on day 1, or maybe superfluous. Maybe they were not absolutely required, and and this is in the spirit of noise trading, if you want. Okay. Now, these are rich data sets. They allow us to go in a lot more detail, and in particular, we have information about demographic, about the trading patterns over time. We can track households as well as institutions over time, so we can try and figure out which types of investors are the most distractible. Okay, so what we do in this particular chart, so this table is all about the household data set, but we do the same thing with the institutions data set. We segment the population into groups. So, for example, by gender. And the idea being that it's been documented in the literature that men are more overconfident than women, and that as a result, their trading performance is significantly worse than women. They trade more and do not perform any better than women, essentially. And so they erode their performance in trading fees and the likes. So we find that actually women are not distracted on these sensational news days, but men are. This is suggesting maybe there's a role of overconfident. So we have various proxies in that spirit. So let me just mention a couple more. If you look at how much these households trade in relation to the profits they book. So if you have households that trade a lot but make losses, then these would be qualified as being overconfident. And we find, so this is what's known as a JK index or JK proxy. We find that households that trade a lot without making profits, which are known as are qualified as being overconfident, also are the ones that are distracted. And finally, we also have it is known also that households tend to trade more the stocks that are in the media, and sorting households on their propensity to be to trade stocks that are covered in the media, again we find that those households that trade the most the stocks in the media are the ones that are most distracted. So all in all, this paints a picture in which those households that are distracted tend to be mostly those that are biased, that have some kind of cognitive limitations, or maybe that enjoy trading, that is, they trade for the pleasure they derive from it, and so on. So these are households that we would think of as being noise traders. Okay. So we conduct a similar analysis with institutions, get similar conclusions, except we don't have the gender the variable, but it's about the same. So conclusion from this part of the analysis is that households and institutions are distracted on sensational news days, and particularly so for those who qualify as being noise traders. Okay. If you look at the broader data set, for example, the TAC data set, which is really comprehensive rather than looking at particular brokerage data or institutional data, so comprehensive data, but which has the drawback of not being able to pin down whether we don't have time series, panel structures, we don't know demographic and so on. What we find a similar pattern when we segment the trades into small and large trades, and we find that the effects are stronger for the small trades. So this suggests that, and it's in line with the data I've shown you, that yes, institutions and households are distractible, but the magnitude of the effect is stronger for retail than it is for institutional investors. So with this in mind, what we do is we move to the market-wide analysis. So our interpretation is that we have a shock to the intensity of noise trading, which has nothing to do with the economy, with the fundamentals of the economy, but it has a lot to do with that switch on or switches off the intensity of noise trading. Let's see how the economy, the market reacts to these variations in noise trading intensity. Okay. So I'm showing you results which are focused on one particular group of stocks, which are smaller stocks. So essentially what we want to do is to pick up the full magnitude of this effect. We focus on stocks that are predominantly owned or traded by retail investors. So we form three groups in terms of for stocks that are sorted in terms of size. I have same results in terms of stock price, in terms of the fraction of institutional ownership according to 13F filing. So they will give you the exact same picture. So focusing on the bottom terciles in terms of stock size, let's look at what happens on sensational news days. So the first thing we pick up is that there's a decline in trading activity. So trading goes down on sensational news days by 2 to 3%. We find that volatility goes down, again, significantly so, by, depending on the metrics we use, 1 to a few percent. Again, it's modest. It's modest, but this modesty is in line with the magnitude of the effect we pick up for trading. We find that the intraday autocovariance of returns is significantly bigger, meaning that given that on average prices, stocks tend to be negatively autocorrelated, that means that stocks are less negatively autocorrelated on sensational news days. So trading activity, volatility, price reversal all weaken among small stocks on these days. Turning to liquidity, we have various measures of liquidity, but let me just summarize what we find. Essentially, we find that liquidity worsens among these stocks. Okay, and we can break it up into adverse selection, inventory costs, and different components of liquidity. All in all, liquidity worsens. We confirm that these different variables for which we report effects, volatility, volume, liquidity, reversals, they're all tied together. If you run a cross-sectional test across all of these events, it is these events with the biggest drop in trading activity are those that see also the biggest drop in volatility, the biggest worsening in liquidity, and so on. So this suggests that all of these are tied together, and we argue driven by a common cause, that is the drop in the noise trading intensity. So according to finance theory, there are essentially two main determinants of liquidity. On the one hand, we got adverse selection stories, and classic papers of Kyle, for example. Here the story is that market makers are worried to be taken advantage of by better informed investors. They love noise traders because noise traders essentially don't harm them. So when noise trading goes down in the market, market makers are more worried that they can be picked off, and as a result, they widen spreads and liquidity worsens. That's one story. another story of liquidity in financial markets has to do with inventory management. And here, the idea is not about asymmetric information. Information is entirely symmetric, but the notion here is that market makers are risk averse. They have a limited risk-bearing capacity. When there's an excess demand or supply for stocks in the market, they're willing to accommodate that excess supply and demand, but at a price. Right? So if there's too much, they worry that they can't unwind their inventory in the future. And so this a decline in the intensity of noise trading is seen as good news in contrast to the adverse selection story. It means that there's less inventory risk faced by the market maker, and in that case, theory predicts liquidity should improve. Okay? So our results are consistent with a mix of these two. So the liquidity results point to adverse selection. Okay, so we have a decline in liquidity, a worsening in liquidity as a result of a decline in noise trading. This is consistent with adverse selection theories, not with inventory management stories. But we do also pick up a decline in volatility, which is not consistent with the model of Kyle, because in the model of Kyle, adverse selection model like Kyle, we have a risk-neutral market maker. So if you take an adverse selection model and you make the market maker risk-averse, then you can reconcile all these findings and essentially have an adverse selection model with a pinch of inventory concerns, and that would generate most of our results. So we have a model which is that basically rationalizes all these results, and also the benefit of the model is that it allows you to derive predictions of what would happen if, say, speculators were distracted in the market, or market makers were distracted in the market. And if you draw the predictions, we show in the paper that they are not consistent with our findings. That is, the only way you can rationalize our findings within these rational frameworks is by claiming that noise traders are being distracted. So we conduct a lot of robustness checks. We are concerned about the endogeneity. Did we really remove all of economic news? Let me just say one word on that. What a wealth of empirical studies have shown is that news is typically associated with more rather than less volatility, with more rather than less trading activity. We find the opposite. So if it doesn't sound really plausible that our results would be driven by economic news that we would have failed to completely filter out in some way. We are more concerned about the possibility that news pressure may be high when there are no other economic news to report on. Okay, but the data I showed you on the surge in TV viewership suggests this isn't the case. The networks would not choose to rationally only show basically the population is craving this sensational news, right? So it's not being shown. The networks don't discuss O.J. Simpson because there's nothing economic going on in the economy. Doesn't make much sense. And we have lots of other tests that confirm that. Now I want to finish on one more result I find interesting, which has to do with the evolution of that phenomenon over time. As I mentioned, we have a very long time series, roughly 40 years, so we can look at how things evolve over time. What we have found really interesting is comparing, say, the period from 1968 to roughly 2000, from the turn of the millennium to today, from 2000 to 2013. So we break our sample around 2000, 2001, because so much has happened in the markets around that time. We have decimalization in 2001. We have a regulation that has led to the fragmentation of financial markets. We got the digital revolution. We got the rise of algorithmic trading. A lot has happened over time. And when you split the sample into before 2000 and after 2000, we find that, so first, you may have expected that our results to weaken in the sense that it is well known that retail trading has gone down over the years and replaced with trades have been mediated by institutions more and more. This isn't the case. Right? So for one thing, I showed you that institutions also are distracted, so it should not entirely surprise you, but still. So what we find is that the impact of noise trading on trading volume, volatility, and reversals hasn't declined, quite the opposite, has amplified in the recent period. Okay? And most strikingly, if you look at liquidity, it's the reverse. The impact of noise trading on liquidity has attenuated in the later period. Okay, so there's a disconnect here. So for volatility, volume, and reversals, it amplified. For liquidity, it attenuates. We think this has to do with the rise of algorithmic trading over the years. So in order to, what guides us into this explanation is there's not that much data on algo trading and stuff, but so what we have is data from the SEC called the Midas data, which essentially characterizes the intensity of algo trading across different stocks. So it's just, we can segment the stock population into those stocks that have intense algorithmic trading versus those that have weak algorithmic trading. So these are the proxies we use, which are standard in this literature. And what we find is that, so this is conducted over the more recent period. What we find is that the effect of noise trading on volatility, volume, and reversals is stronger for stocks with more algo trading. Okay, which matches what we find in the time series. Remember, we find that our phenomenon to be stronger in the more recent period. In contrast, the impact of our sensational news shock, or our shock to the intensive noise trading on liquidity, weakens or at least doesn't vary as strongly with the intensity of algo trading. That is, there's a mapping between the time series results. So the amplification for some variables weakening and some variables in the more recent period. This matches a cross-sectional analysis in which we segment stocks by the intensity of noise trading. So our interpretation is that in recent times it has been easier to anticipate and predict noise trading thanks to technological advances. So there's been massive improvements in computing power. We have, ultra fast communication lines. There's been also massive improvements in software with pattern recognition algorithms, the big data, artificial intelligence, machine learning, and so on and so forth. So feeding all that data now into systems allows you to better predict what will be the noise trades in the next instant. So this is on the technological side, and at the same time, there's been also new business practices, co-location. Some funds also have access to the proprietary data feeds from exchanges before the news becomes widely available, and so on. I'm talking about the order book and the trades data. So all in all, we can make the case that anticipating and predicting noise trades has become easier in recent times, and as a result, it has become easier for two constituencies to time day trades. On the one hand, agency algos, so these are asset managers who want to optimize, they know they want to buy a particular stock, but they want to optimize the execution of that trade, breaking it up into various parts. So now they can better execute their trades to make sure they are being placed at a time when they will be better camouflaged behind a small screen of intense noise trading. They can better do that. And on the other hand, maybe less rosy if you want, high-frequency traders, which are often being blamed for preying and taking advantage of noise traders, are arguably better able to front-run these noise trades they take advantage of. Okay. So there will be one way of interpreting the findings that our results have strengthened in recent times in spite of the decline in noise trading. I think an important insight is that a single noise trade, it doesn't contribute to trading volume just through that single noise trade, but there's a multiplier effect in that every noise trade triggers or stimulates speculative trades. Right? Speculators trade behind noise trades. So if noise trades go down, if you lose one noise trade today, then many speculators will withdraw from the market. And this happens more so in recent times than it has happened, say, 20 years ago. Okay, so let me conclude. We find that noise traders are distracted by sensational news, both for institutions and individuals. But individuals tend to be more distracted. These effects are stronger for more biased investors. So maybe a result that some of you may be interested in is that individuals actually benefit from watching TV, right? Because it distracts them from doing worse things. We know that they trade too much, they lose money from trading. Let them watch TV and they'll be eventually better off. And in this study, we use sensational news to assess the impact of noise trading on financial markets, and we find causal evidence that these noise traders drive adverse selection in financial markets. And then in the age of algo trading, the effects on volume, volatility, and reversal have been magnified, while those on liquidity have dampened. And this is related to the ease with which one can anticipate those trades.